China's economic growth reaccelerated to 5% year-on-year in the first quarter of 2026. However, we think this might be the peak for this year. We expect growth to slow down again due to China's K-shaped recovery. First, real estate investment remained the key drag. Real estate investment fell by more than 16% in the first 5 months. The prolonged downturn in the property sector continued to weigh on the traditional sectors linked to the construction activity. Cement output, for example, fell 8.1%, while the flat glass production declined 6.3%. In addition, the property downturn continued to spill over into the household spending. Furniture sales declined 8.7%, while the sales of the construction and decoration material fell 13.6%. Households remain reluctant to add leverage. Median and long-term household loans declined for a second consecutive month in May. The continued contraction in the household loans appears inconsistent with the perceived recovery in the housing transaction volume. One possible explanation is that the recent improvement in the property market has been concentrated in the low-ticket owner-occupied demand. In Shanghai, for example, improving rental yields have supported demand for the homes priced below 3 million renminbi. Many of these purchases may have been financed through the Housing Provident Fund loans and the self-owned funds, rather than commercial bank mortgage. As a result, the recovery in the housing market sentiment has not been fully reflected in the bank credit data. Second, retail sales weakened further, pointing to a softer consumption backdrop. The pull-forward effects of the consumer trade-in subsidy program are becoming more evident. Autos were another major drag. Meanwhile, consumption downgrading remains a notable trend. Catering revenue grew 0.6% year-on-year, while the revenue at the large-scale catering enterprises fell 1.7%. So this suggests that consumers remain cautious and continue to trade down amid ongoing pressure on the income and employment expectations. Third, slower fiscal support in the second quarter likely add pressure on the fixed asset investment. Boost from the front-loaded fiscal funding and the concentrated project launches in the first quarter is gradually fading. That said, high-tech manufacturing remained the key bright spot. For example, value-added output of the high-tech manufacturing increased 15.1% year-on-year in May. In addition, emerging industries continued to post strong growth. Production of the lithium-ion batteries surged 40% year-on-year, while the industrial robot output rose 27.9%, highlighting the continued strength of China's advanced manufacturing sector. Overall, the latest activity data point to a further moderation in growth momentum, while the high-tech manufacturing and the AI-related sectors continue to provide important support. Weakness in consumption, property, manufacturing investment, and infra spending suggests that the broader economy remains under pressure. We expect China's GDP growth to slow to around 4.5% year-on-year in the second quarter. Nevertheless, the economy remains broadly on track to achieve the official 4.5 to 5% target for this year, and we maintain our full-year growth forecast at 4.7%.